Assalamu alaikum friends, welcome to question number 54 Evolve from an SBR revision kit. So in this question, what are we going to cover? Let's see. The first requirement is regarding IFRS 5, as I can see from here, for 7 marks. Second one is regarding something to do with tax. Looks like it is IS 12, but we'll see. For 6 marks, we have IFRS 3 also in that. Then we have for part B the 2 professional marks for this with 10 marks. This is regarding practice statement, materiality practice statement. Okay. Discuss why the concept of materiality is so important to preparers and the users of financial statements for 10 marks. 5 marks for preparers, 5 marks for users. Okay. When you are making this, why materiality is important, you have to include in your answer the both materiality practice statement. What does they say? Okay. We'll come to that later. First we'll finish part A. The 2 requirements. First one is, this is regarding a real estate company. Okay, at 31st August 2006, they control a wholly owned subsidiary resource whose only assets were land and buildings. So he's a subsidiary, only assets were land and buildings, which were all measured in accordance with IFRS 5. On 1st August 2006, Evolve published a statement stating that binding offer for the sale has been made and accepted. On 1st of August, okay, they made a binding offer for the sale that has been made and accepted, and at that date the sale was expected to be completed by 31st August 2006. At that date, okay, sale was expected to be completed by this date. The end. Non-current assets of resource were measured at the lower of their carrying amount of fairly less cost to sell at 31st August 2006 based on the selling price in the binding offer. This measurement was in accordance with IFRS 5. However, Evolve did not classify the non-current assets of resources held for sale in the financial statements at 31st August 2006. Why? Even though they know it meets the criteria, why did not they classify? Because there were uncertainties regarding the negotiations with the buyer and a risk that the agreement would not be finalized. There were no disclosure of these uncertainties also, and the original agreement was finalized on 20th September 2006 after the year end, which is 31st August. Okay, so 7 marks. So how are you going to account for this? Definitely most of the answer for this is IFRS 5. Okay, you have to use your knowledge of IFRS 5. So in first para you have to say what does IFRS 5 says. Okay, they say that assets should be held for sale. When should you held the asset for sale? If its carrying amount will be recovered through a sale and that sale is highly probable to occur. 1 mark for that. Second, we are going to relate this to the case study, link this to the case study regarding the binding sales agreement. So IFRS 5 does not require the existence of this binding sales agreement to classify it as a non-current asset held for sale. Okay, you don't need any agreement, but only high probability of its occurrence that is going to occur. You need that probability only, that there's a probability that the sale is likely to be occurring. If that is there, it's enough. IFRS 5 states that appropriate level of management must be committed to plan to sell the asset. You need level of management also. Management should plan to sell that asset. Okay, their acceptance of a binding offer in August 2006 and the publication of this information is an indication that there's a high probability of sale to take place. Why? Because you have publicized, okay, you have accepted the offer. So this are indications that the probability is there. High probability of sale is there. Whatever the uncertainties are regarding the sale, that does not matter. But this transaction remains highly probable at 31st August 2006. You see, second mark is for this. It is only looking at the probability. How can you say this probability? You have to dive deep into this. One, look at their plan. Second, how do you know that they are planning to sell? Management, they have publicized, they have accepted the binding offer on this date, so probability is there on this date. Second, okay, so one is You are telling about this probability. Second, you are linking. So 3 marks, 1 and 2, 3. It is for 7 marks, right? Is it? It's for 7 marks, yes. Now 4. So this here you are going to get 4 and 5, 6 and 7. Okay. Other criteria indicate that this should be shown as held for sale. Include that a buyer for the non-current has been found. Now we are talking about the buyer. Second thing, why it should be classified as held for sale? Because buyer. One, you are identifying. Second, you are linking to the case study. So buyer, okay. If you have found a buyer, you have to show it as a non-current asset held for sale within 12 months of classification as held for sale. The asset was actively marketed for sale at a price which has been accepted, whatever the uncertainties might be. Okay. So all this suggests that the contract is still there, it did not change significantly, or the contract is not withdrawn. The fact that information regarding the uncertainties were not disclosed is irrelevant in this case. Okay. 6. So they cannot apply IFRS 5 measurement criteria, Evolve, without classifying the item as held for sale in the statement of financial position. Particularly as when impairment may arise when using such criteria. Okay. You cannot. You first have to classify something as held for sale, then only you can apply the rule of IFRS 5. Otherwise, you cannot use the measurement criteria. Okay. Next. So, thus, as the non-current assets met the criteria to be classified as held for sale, they should be measured as well as presented in the financial statements as such. How are you going to present them? Assets held for sale are presented separately within the current assets. Within current assets, they are no longer non-current assets because within 12 months you are going to sell. So within current assets, present them separately on the face of the statement of financial position. Okay. Now we are moving to the second one, business combination. We have investment property, right? As you can see, there are different standards. One is IFRS 3, one is IS 40, one is IS 12. Okay, it is for only 6 marks. So let's read. They operate in a jurisdiction with a specific tax regime for listed real estate. Upon adoption of this tax regime, entity has to pay a single tax payment based on the unrealized gain of its investment property. Evolve purchased Monk, whose only asset was in investment property of 10 million. The purchase price was below the market price of the investment property, which was 14 million. Evolve choose to account for the investment property under the cost model. They consider the transaction considered a bargain purchase. See, you might sometimes have a goodwill or a bargain purchase, right? As a result, they Evolve accounted for the potential gain of 4 million in profit and loss and increased the cost of the investment property to 14 million. At the time, they opted for the specific tax regime for the newly acquired investment property and agreed to pay the corresponding tax of 1 million. Evolve considered the tax payment qualifies as an expenditure necessary to bring the property to the condition necessary for its operation and therefore was directly attributable to the acquisition of the property. They are saying that this tax is required for you to bring the asset to its appropriate location and condition. That means this tax you can capitalize as a cost of asset. This tax of 1 million. That's what they are saying. Hence, the tax payment was capitalized and the value of the investment property was stated at 15, from 14 to 15. You have to say whether it's correct or not. Obviously, it's not correct. You have to correct the treatment. Okay, to correct the treatment, you should know according to this one. So, which standard are you going to use first? Start with IFRS 3, business combination. Okay. So, this you use it when you are accounting for business combination. Okay, 1 mark for this. When you're buying a business, then you apply IFRS 3. For example, subsidiary. Subsidiary is a business that you are buying. Then you use IFRS 3. But this does not apply when the acquisition is not of a business. When you're just buying an asset, then you cannot use IFRS 3. In this case, you are linking to this case. Acquisition was essentially that of an asset. You are buying an asset, not a business, because it's an investment property that you are buying. Therefore, the measurement of IFRS 3 would not apply. Just 1 point, that's it. 1 mark. You cannot use IFRS 3 because this is not business, this is an asset. Now we are moving towards asset investment property. Okay. So investment property, when you want to know what is the recognition, you have to go back to the investment property IS 40 and see what are the costs that can be capitalized. One is purchase price. And any cost that is directly attributable, any expenses, you can capitalize it. For example, professional fees. You sometimes need these professional fees. Legal services. You can capitalize this cost along with the purchase price. If Evolve is to use the cost base for accounting, okay, if they want to use the cost base, the gain should not have been recorded in profit and loss or added to the cost of asset. Understood? You cannot take the gain and you cannot recognize it in profit and loss or add that to the cost of asset. The gain. If you are using the cost basis. So the specific physical treatment has to be paid when not linked to the bringing the C. If you are going by the tax, this tax is not related to bringing the asset to the condition necessary for its operation. You don't need to have to pay this tax to bring the asset to this condition. Without this tax also, you can bring the asset to this condition. There will be some other expenses. Okay. So because of that, as the asset would have been operated without the tax, you can still operate this asset without the tax also. Okay. So tax is a cost that is linked to the activity of Evolve and should be accounted for as an expense. It should be accounted as an expense in accordance with IS 12, not capitalize it, and including profit and loss for the period. Okay. So what are the things that they have told here? Please understand. They're not telling you to calculate. Yes, it's true. They have given you some figure 14 and 1 and all. But you have to say that these things should not be done this way. That's what they are asking you, to correct the treatment. They're not asking you to calculate something and tell you. For example, tax you cannot capitalize. It should be an expense and it should be recording profit and loss. For example, IFRS 3. It is not a business combination. You cannot apply it. It's an asset. So 2 marks for assets, 2 marks for telling that it's not a business combination. It's an asset. And another 2 mark is for the investment property. The cost that can be capitalized. So that's how you're going to get the 6 marks. Okay. Now we are coming to the materiality. Okay, if you see under materiality, profit and marks are there. You have to use appropriate subheadings divided in paragraphs. For example, here start with the definition. Always materiality is there, start with their definition. Definition is same. Then importance of materiality to the financial reporting. Okay, you see it's quite lengthy. You'll be getting 1 mark for each point. And it's 10 marks. So this much is expected from you. Now, but if you see this is very small, you don't have to link to the case study because nothing to link. You have to use your knowledge of materiality and the practice statement. So International Accounting Standard Board is undertaking a broad-based initiative to explore how disclosure can be improved. Disclosure initiative is made about number of implementation and research projects, one of which is materiality. The board has now issued a practice statement. Practice statement provides further guidance on the application of materiality to financial statements. That's it. Nothing from the case study you can take. Basically, they are trying to improve the disclosure. Because of that, they have implemented they have come up with practice statement which says how to apply the materiality to the financial statements. So for 10 marks, it's an open-ended question and it's very difficult to know how to get the 10 marks, 10 points. Is it for my definition of materiality? Is it for saying from practice statement? What should you exactly say? Okay, so first, okay, start with the definition. Definition will give you 1 mark. Okay. So from definition, 1 mark is this, 1 mark is this, and 1 mark is this. 3 marks is gone. First definition is what? When you omit or when you misstate, if it is affecting the decision, influencing the decision of the user, it is material. Second paragraph says, when you have to assess materiality, what do you have to consider? What do you have to take into account? Whether information is relevant to the users or not. The one who is going to read their financial statements. Okay. In other words, materiality has to be entity specific. It should not be general. That's why when you are reading the financial statements, it will be different from every user. Every financial statements for every company will be different. Information that is given there, because materiality is very entity specific. Every entity has their own way of analyzing materiality. Concept of materiality. What is material for one company might not be material for another company, because it is entity specific. Okay, so before you say that this is material or that is not, you should understand your user. Preparer should know their user, who are their users, and for them what might be material. Okay, that's because of that they should have a reasonable knowledge of business and accounting, the business also. Okay, third, now the question says, requirement says link your answer should indicate practice statement. Okay, so it's up to you how you're going to bring it into your answer. When are you going to make use of it? For that you should know what is there in the practice statement, what does the board propose. So the materiality practice statement emphasizes the material judgments are not just quantitative. First you told the definition, omission or misstatement. Second you told entity specific. Third, now you are saying it should not just be on quantitative only. That if this number is 10 million, it is material. If it is 1 million, it is not material. No, it's not on quantitative only. It's just not quantitative means, yes, quantitative is also there. We are not ignoring the fact, but not only quantitative when you're making materiality judgment. That's what the practice statement says. How will you know this point if you have not gone through the practice statement? This is why I always tell you, go through the practice statement. Okay, it is there in your current issue chapter. If you are going from the textbook, and in my lecture under current issue, it's there. Mostly I would say towards the end of my lecture of current issue, practice statement, I've mentioned about materiality practice statement. So these are not just quantitative transactions that trigger non-compliance with laws, or which impact future operations, may affect user decisions even if the monetary amounts involved are small. So how do you say it's material? See, when you're making judgments, you have to see if you are not complying with the law. There are some areas where some transactions where which triggers that you are not complying with the law. Because if you comply with the law, you might recognize a loss or less profit or something like that, whatever it is. Or it might affect your future operations, or it might affect the user decisions. Even if the monetary items are small, monetary items could be small, but if you are not complying with the law, it can affect your decision. It might affect your future operations. It might affect the user decision. So in that case, even if the monetary amount is small, it is still material. You still have to disclose it, because it is affecting your user decisions, affecting your future. Now we are moving to importance of material to financial reporting. Okay, again we'll read the requirement just for better understanding. Why materiality is so important to the preparers and the users? We just told some definitions of materiality, that it has to be, first line is definition, omission or misstatement, affects user, then material, second entity specific, third not quantitative. Now we are moving to the importance. Okay, so out of 10, 3 marks are gone, now 7 marks. What is the purpose of financial reporting? This is from your conceptual framework also, you will get it. To help investors. One, user is investor. We are talking from user as well as from the preparer's point of view, remember. Use investor, lender, and other creditors. Remember, this 3 user, it's enough. You don't have to know all your stakeholders, customer, supplier, everything. No. Main is investor, lender, and other creditor. Why? Investor is going to invest in a company. You need that investment. Lender, because you need for financing. They are going to finance in your company. Other creditors, short-term creditors and all, you need it to finance your working capital. So all these 3 users are very critical. Yes, definitely supplier, customer, competitor, all these are also there. But these 3 are important. For this 3 user, you are giving the financial reporting information. Your customer will not ask for your financial statement of the company. Your supplier will not ask you for your financial statement. If yes, it might be important for them, it might be useful for them, they might need to know certain information, but it's not very critical for them. You're not making for them. They are involved in that stakeholder group, but it's not involved for them specifically. You are reporting this for investors. They want to know. Shareholders, lenders, definitely they want to know. They want to know what is your position. Based on that, they are going to lend or credit rating or do whatever. So these 3 are your user, primary user. Whenever we talk about user, specify your answer towards this 3. Lender and creditor, more or less, they are similar characteristics, but investor, yes, investor and finance provider. two groups. Okay, so purpose of them is financial reporting is to provide information to this user, because on this they are going to make economic decisions. Both of this user, they provide entity with resources. Investors also provide with the resource, lender also. Lender give them finance, investors give their shares and whatever it is. They invest in the company and all those. Okay. So because of that, okay, it is important that management should consider this materiality throughout the process of preparing financial statements. Throughout, they have to maintain this. They have to ensure that relevant information is not omitted as well as misstated. Sometimes you omit it completely. Sometimes you put it there, but you misstate it. You overstate, understate. Amount is not correct. So both of this case should be avoided, right? The practice statement details a 4-step process. You will get marks for this. You might not have to explain each point. You don't have to explain very in detail. Briefly, if you write those points, you will get marks. What are those 4-step process? Number 1, identify. Everything starts with identification. Identify the information that might be material. Second, assess whether that information is material also or not. It should go in this order, by the way. You cannot change this order. First, you identify. Second, you assess. Third, organize the information in draft financial statements. Obviously, before you make the financial final version, you always make a draft version, right? Fourth, review. Then you review whether everything is okay, it is material, draft, okay? So these are the 4 steps. Okay. Now, so each point you can give in different paragraphs. That's how you're going to get 1 marks each. For example, this will give you 1 mark each. So management should produce. But definitely for this all 4 steps, you are going to get 1 mark only, not 4 marks each. Okay. So out of 7, maybe 1 for this, 1 for this. So 2, 3, 4, 5, 6. Or maybe the last one you're going to get 2 because you're talking about a specific standard. So yeah, that's how you're going to get the 10 marks. Just count. Okay. Remember, management should produce financial statements that are free from error. Okay. However, the impact of certain transactions, they might be omitted or they might be simplified. As long as resulting errors are immaterial, remember, we are talking about the importance of materiality. Yes, it has to be free from error. So because of that, you might omit or you might simplify also. So that error is reduced, but it should be immaterial. If resulting errors are immaterial, then you can omit or simplify. Okay, in every point, make sure that you talk about practice statement. This will help you more to write. So the materiality practice statement recognizes the simplified accounting procedure. What is it? Such as writing off all capital expenditure below 1,000 to profit and loss. That means all the capital expenditure that is below 1,000, you write it as an expense in profit and loss. You are simplifying the accounting procedure. This can greatly reduce the burden of financial reporting without causing material misstatement. You see, you are showing an importance of materiality. You are reducing the burden also, but you are not causing any material misstatement. Next. This is in 1 paragraph, by the way, this whole thing. Okay. The concept of materiality does not just help to determine whether transactions are recognized in financial statements or not, but also how they are presented. It's not only about the recognition part, it's also about the presentation part. Concept of materiality not only it helps in recognizing that if it's material you recognize, if it's not material you do not recognize. It also helps in presentation. When something is material you present, if it's not material you do present, or even if you present you aggregate and you present. Understood? So they may decide to present. See, you're talking from the point of preparers and user. Now you're talking from the point of preparers. For preparing also, this is helpful. Okay. So management may decide to present some material. Management means prepare. Management is the one who's going to prepare. User is the users, lender, creditor, and investor. Okay. So they may decide to present some material transaction as a separate line item. Correct, no? You might present material transactions in a separate line items in financial statements. Whereas the effects of other immaterial transactions might be aggregated. You see? Now, in this, let's stop. First, you give a point, how this will, what they will do and what they will be doing it in this case. Importance is it helps in presentation also. Then link to the practice statement. Give an importance, link to the practice statement. Give importance, link to the practice statement. That's how you can build up this answer. In this case, in the presentation, what does the practice statement says? Emphasize the importance of these decisions. What is it? Too much detail can obscure important information. Yes, you might be presenting in a separate line, but remember, practice statement says too much information can obscure important information. That means important information is hidden inside the too much detail. Whereas over aggregation, if you over aggregate things, it might lead to loss of relevant detail. Sometimes relevant detail might be hidden in that aggregation. You don't know what is it. Aggregation. It is just aggregated and you are given just one figure. But that one figure is made up of what? You don't know. Now, finally, the last. Disclosure notes. It impacts disclosure notes. So, you can talk about recognition, measurement, presentation, disclosure. These 4 areas, materiality is important. Okay? Guidance is important. Why? Because financial statements now, if you see the financial statements, the reason financial statements, reason companies, just look. Disclosure notes are so many. It's like it is cluttered. Okay? In recent years, it is too much cluttered is there. Because the disclosure requirements in IFRS standards have expanded now. Now, under each IFRS standard, they are expanding this requirement. They want more and more and more disclosure. That means more and more and more clutter. However, as IS1 also talks about presentation of financial statements. What do they say? They state that entity did not provide a specific disclosure required by IFRS standard. If the information is material, that's what IS1 says. Even if information is required by IFRS standard, you don't have to disclose it if it's not material. And the practice statement says that the common information needs of primary user groups should always be considered and that disclosure requirements in IFRS standard should not be treated as a simple checklist. Okay? That means you just don't tick by looking at the disclosure requirements in IFRS standard. That this you need to disclose, tick. This you need to disclose, you do. No. Practice statement says importance has to be given to that also. You have to consider what is the information in need of the users also. Common information need of the primary user. For example, lender, investor, the creditor, the lenders. For them, they might be each having some common information that you have to provide whether it's material or not. Maybe for that group it's material, but according to IFRS standard, it might not be material. So in that case, practice statement case, if you go, you have to give that information. So you see, it's very contradicting. IS1 is saying something else. IS1 says if information is not material according to an IFRS standard, don't disclose. Practice statement says disclose even if it's not required in IFRS standard. If it is not considered material according to IFRS standard, but it is considered material for a certain group of primary user. So it's contradicting the two things. Okay. So if you are able to present like this, I'm just giving an example. I'm not specifically telling that here only you are getting the professional marks. But here what they told, that contradicting nature they give in IS1 and practice statement. If I'm able to present your answer like this format, IS1 says this, practice statement says this, you will get your professional mark. At least out of 2, 1 professional mark you will get here if you present like this. The second professional mark is your presentation. You see how you are presenting your answer. You have clearly labeled the definition and the importance of materiality to financial reporting. Or some of you might present this answer in a different way. For example, definition, then importance to preparers, importance to users in a separate paragraph. That also, in that case also, you will get marks. Okay. So that's it for this question, and see you in the next question. Till then, take care. As you know that we are coming towards the end. We're just 2 questions away from our completion of revision kit questions. We just have 2 questions left. So see you in the next question. Until then, take care and God bless you.